Okay, so welcome back to Day Trading with Tony. And we're going to talk about setting up charts today. And in this lesson, it's all about charting, understanding triggers, recognizing windows, etc. So we're going to go over setting up your charts. We're also going to look at daily charts and understanding the importance of those windows or pockets of safety for both long and short positions. Okay. So let's see. I just charting is technical analysis. Technical analysis is a form of interpreting the price action and understanding critical areas of support and resistance. So there's a lot of different forms of technical analysis, and they're all within charting, but charting by itself is very technical, right? So we can be fundamental traders, we can be value investors, but for the most part, I'm a pattern trader. So because this is a chart pattern that I'm looking at, and not an earnings report, an earnings pattern, or a cyclical sector pattern or something like that. It's a chart pattern. It's a technical pattern. That's the type of trader that I am. So by using technical analysis, we can look at charts and we can find areas where we're most likely going to have a large number of either buyers or sellers, depending on what the patterns are telling us. And when we get to these critical levels, we'll often see large amounts of volume coming in. So the volume is just like we've talked about in the last couple of lessons. It's confirming that other traders and possibly institutional investors as well are interested in these stocks at these critical levels. So we can learn to anticipate where the volume will come in. We can learn where the breakouts are areas on the chart that are very common for a lot of shorts to cover or a lot of buyers to come in for a potential squeeze. And by anticipating these, we can have our orders ready to go. So when we start seeing the volume, we're ready to jump right in. That's really important. It gives us a little bit of an edge or a leg up because we're already watching the pattern unfold. We don't have to wait for some of these stocks on an intraday basis to hit the high of day scanner. We're already watching them before they hit the highs. So when they're hitting the highs, we're already in. And then on the other hand, by purchasing these stocks right at the breakout spot, we avoid holding during consolidation. The other day, I was talking to someone about managing risk. In fact, we covered this in lesson 2, I think it was. We're talking about risk management. One of the areas of managing risk is in our exposure. So that's just the amount of time that we're actually holding stocks. So if we can reduce our exposure by holding stock for a shorter period of time and still generate a significant profit, then that's a really good thing, right? That's always what I'm aiming for. As much as I can, I want to get a relatively quick profit, and that's the goal. And sometimes I end up holding it a bit longer, but I'm able to time my trades based on recognizing the patterns and anticipating where big volume is going to come in. So there's different types of analysis: technical analysis versus fundamental analysis. And there can be some overlap between these two types of analysis when you decide to get in a position. But here's the thing. You never want to, just the way we don't want to adjust our stops to accommodate a bad position or a losing position, we don't want to start doing a fundamental analysis to justify holding a losing position or a losing trade either. If we're in a trade like Nike and all the technicals are saying get out, and then we think, well, you know what, Nike's a strong company, and I really like sports shoes. I like going running. Maybe I'll hold it. We're starting to combine now that we're starting to combine fundamental analysis. Retail sector's good right now, so the shoes are really popular amongst teenagers and you like. I think I'm just going to hold this for maybe a couple of weeks and see what happens. Do you know what you've just done? You've changed your risk parameters mid-trade to accommodate a loser. We never want to be doing that. One of the problems that a lot of fundamental traders will have is that the fundamentals may be very good, but not so much the price action. It just doesn't follow. It can be very confusing when you hear a stock has bad earnings and then it's trading up, right? Or it's got good earnings and it's trending down. It's not easy to understand. It can be hard to understand at times why the price action seems to completely defy what's logical in terms of fundamental analysis. But it happens a lot. So for me, I've just learned that I really can't get caught up in doing the fundamental analysis, and that's why I don't do a lot of research late at night and stuff like that. I'm not digging into reading all the earnings reports and digging into all the news, because I found it really didn't help me. Even when I thought I understood the news and maybe I did the price action, it might do something different. We just have to follow the price action. For the most part, we're getting into these trades on the 5-minute chart or the 1-minute chart. And we're going to trade them on the 5-minute or the 1-minute chart. And fundamentals on the 5-minute chart pretty much don't matter. They don't matter at all. The fundamentals are applied more to daily and long charts. It's relevant for swing traders and value traders. Either short-term, long-term traders and mid-term investors are more interested in the fundamental analysis. But on intraday level, we have to focus on the technical analysis, and that's where we focus on. That's why we look at the charting, we look at the price action. So technical indicators, if we look at technical indicators, a lot of people ask me what technical indicators I use. And I'll come into which ones I actually use and which ones I recommend. But what are technical indicators first? I think that's a good place to start. In your charts, you can find multiple technical indicators. If I just pull across the trading view here, for example, and show you a little bit about this here. So when we look at on this trading view chart here, we can look at indicators, and we've got various indicators that we can look at, candlestick patterns, but let's look at the technicals. We've got a lot of different things here, the ATR, Bollinger Bands, there's a whole, and different investors, different traders, different people will use a lot of these. You can see there is a huge amount of different technical indicators that you can avail of here. The price oscillators, relative strength index, etc. A lot of these indicators people swear by, but essentially what I want to say is technical indicators are each one of them is a complex set of formulas, and they give us context for current price action. So some indicators are oscillators, they go up and down with price action, and if an oscillator is bottom out, or like an RSI for example, that's telling us typical that the price action of the stock is also bottoming out. Now if we just look at the stock, we can bypass the middleman, which is that indicator, and we can see that it's bottomed out. Just get rid of that. On the other hand, it can be helpful to have that histogram or that oscillator or whatever as a visual representation. that you have that indicator. It can be helpful to have that there just as confirmation that what you can already see. Uh, if you like it, there's no harm in having that there. I personally like to keep my charts very clean, but if you like to see that, it's great, and it'll give you confirmation that the stock completely bottomed out. Could be a good indication potentially for maybe a reversal, a bottom bounce reversal, for example. So seeing that number or on something like an RSI that you've got a 4 or a 3 RSI, it's just additional confirmation that this stock is really hitting the lows, and at some point it's got to reverse. But it doesn't by itself mean we should buy just because something is hitting a 5 RSI. Doesn't mean that it can't still sell off for another 2 or 3 points. So we can't rely on technical indicators to give us our entry and exit goals. There are certainly some systems, and you see this a lot more with forex traders and other types of trader that have tried to rely on a red light or green light type of indicator system where whenever something meets this formula, they buy, and wherever it is like this, they sell. So typically, anytime those work, it's going to work for a short period of time, and then it's going to stop working. One of the reasons is when you do a back test, and you have a computer system run the test of this formula over a set of 2 months, you'll get the results, and you look at the results, and you'll start tweaking the formula. Eventually, you tweak the formula enough so it returns a beautiful, beautiful profit curve, a really, really nice looking gain, right? So you think, okay, I've got this formula right, which is really, really profitable. I've back tested it over the last couple of months and it looks terrific. And then you run it live for a month and it loses. And you think, what the heck? And you do the back test a month later, and the result that was 80% is now only 50%. So you go and start tweaking it again, and what you end up doing is tweaking these indicators to match what you're actually matching the indicator to a set of back test results. It's called confirmation bias, if you will. They don't have any future or forward value. They're only looking backwards. They're lagging indicators. It's like people that write algorithms around this, and this is why people ask me about trading bots, and very often these trading bots are trading on these lagging algorithms, and I'm not a big fan of these trading bots. I think that they more often than not will take your money and lose it for you. Okay, it's just going to be doing that again and again and again, because it's all about what's happened in the past and not having any real relevance on what's going to work forward in the future. It's just not profitable. So instead, we look at patterns that have more consistency. And maybe you can't scan for them, or you can't write formulas. I mean, how do you write a formula for a bull flag or a flat top breakout? But you can visualize them, and you can use them. You can use your own analysis, and that's where the human interpretation comes in. It comes in, and this is our really our advantage over the high frequency traders. Remember, I was talking about 60% of the volume of the market is these high frequency traders, the hedge funds that are doing computer-based trading, and they can't recognize the patterns in the same way we can. So we come in, we analyze the visual aspects of these patterns, and we're able to make a decision based on the patterns. Technical indicators, in general, I don't really rely on them. I use them just to confirm what I may already suspect. So if I suspect a stock is bottoming out, and I look at the RSI and it's a 5 or a 4, it's just confirming what I've already seen. So I use it only in that way. it's also worth noting that technical indicators, as I say, they lag behind the price action. We want to be concentrating on the price action and patterns that are forming within the price action. The technical indicators, they get their information from the candlesticks. So it takes a little bit of time for most of these indicators to form, because if you're looking at the 1 minute chart, for example, a 1 minute candlestick, these technical indicators, they don't actually plot that point until the formation of that candlestick is complete. So they're waiting for that candlestick to complete before they get the signals. So if it's a 5 minute delay or a 10-minute delay or even just a minute delay, they're usually lagging somewhat behind the price action. So what's what I mean by lagging indicators? And a few of these lagging indicators, I mentioned there the relative strength index, or often known as the RSI. There's the MACD, which is a moving average crossover indicator. We've got the money flow, the alligator indicator, which is also just a moving average crossover. And then there's hundreds and hundreds of indicators I just showed you a moment ago. The whole problem is that they're all lagging. They're all based on data that's already passed. And as a day trader using the 1 minute and 5 minute charts, I can't tolerate the lag. I want to see what's happening now. I want to see what's going to. I don't want to know what happened 3 minutes ago. I want to know where the price action is now. If I could have a 10-second indicator, if I could have a 10-second chart, I probably would have that as well, and look at a 10-second chart to potentially time my entry and exit points even quicker. And you're not going to get that from lagging indicators. It's just going to ruin our chances of having profitable trades if we wait for that. If we're waiting for some signals to give us our entry or exit indicators, So the area where you can do a little bit of combining technicals and fundamentals for me is when you're preparing your watch list in the morning. I do look at the fundamentals there, of course, because I want confirmation that there's a fundamental reason why the stock is actually going up. Beyond the technicals, the technical says the stock's gapping up 80%, but from a fundamental perspective, you want to know why is it gapping up? What is the catalyst? So knowing that there's a fundamental catalyst, whether it's earnings or some type of activist investor or an FDA approval or clinical trials or whatever it is, I want to know that there's a reason, and I want to be able to do a little bit of research and get a few other opinions, and I can do that in a lot of ways just by looking through social media. Of course, I've got my Benzinga scanners. I can click on there and it will give me news catalysts right away. I can actually dig a little bit deeper into that particular stock and find out a little bit more history on that stock. A lot of that's in Benzinga as well. So obviously I'm not going to base my investment choices on random opinions on, say, social media, but if you're looking at forums such as Wall Street Bets on Reddit, or you can go on to Quora and look at opinions on there as well. I mean, how many Facebook groups can you find about stocks? There's literally thousands of them. I'm not going to base my trading action based on some randomer's opinion on social media, but they can help me form a more rounded opinion on whether this is a long or a short. Whether is it for me a trade worth me taking. If I'm trading, I don't want to go into crypto too much, but if I'm trading crypto, I do often look at social media. I do often look at the various forums for a more in-depth, rounded viewpoint on crypto, for example. uh, because very often the trading communities around a particular crypto technology can have impact on the price action as well. But as I said, I don't want to go into crypto on this lesson. Maybe on a different class. But for this lesson, we're concentrating on combining the fundamentals and the technicals of analysis of the stocks that we pick. So, stock twits, Twitter, Facebook to a lesser extent. Each morning we can do a little bit of a combination of technical and fundamental analysis. We look at the technicals, we confirm the gap, we confirm it's going to have high relative volume, we check the float, we see how many shares have traded pre-market. You know, we look at the course of the daily chart, and which we're going to talk about here in a few minutes. And then we start to figure out what is the news on this thing. If all those technicals check out, well, now what are the fundamentals? That's when we combine it. It could well be that this is a stock in the oil sector, and that sector right now is very weak, so maybe we don't even want to trade it because we don't like the sector it's in. Or maybe we see it's a pharmaceutical stock, and that's a really hot sector right now, so that makes it even more exciting. Yeah? Does that make sense? I mean, it's important to understand some of the basic fundamentals, but you don't, at this point, at least in my opinion, you don't have to dig into, you know, the detailed research and stuff like that. You know, at the end of the day, we're day traders. We're not holding these overnight. We're not holding them through earnings. So our risk exposure is really a lot lower than someone who is longer term investor, a value investor. We just don't need to do all of that research before we buy something. So, in terms of setting up your charts, I think a cleaner chart is better. I tried to keep my chart as clean as possible. So I would say, if you can, throw away all technical indicators. I rely mostly on moving averages and the candlestick patterns themselves. The candlestick patterns are just going to form naturally. You'll see on my charts that I have a few indicators on there, mostly volume related, but you know, I certainly don't rely on them. They're there and they can be helpful at times, and they can be helpful for new traders, which is one of the reasons that you know, I'm going to talk about them now and show them. And they can be useful if you're actually trying to teach somebody about, you know, technical analysis as well, that sort of thing. But in terms of the moving averages, there's three that I would use in terms of moving averages: the 9, the 20, and the 200. And I use exponential moving averages. I also use, and this is the biggest one for me, the volume weighted average price, which is called the VWAP. So the volume weighted average price is a moving average that takes into account how much volume is trading at these different prices. So if you have an area on the chart that's mostly flat and then has a big spike up with volume, the VWAP is going to spike up sharper. It's going to spike up much sharper than a moving average, which doesn't care how much volume it goes off. It just looks at the high and low of the previous candle. So the VWAP is, in a lot of ways, it's sort of the equilibrium balance point of a stock over the course of the intraday period. So when we think about a good analogy to use when we're talking about the VWAP is the rubber band concept. That is the price action. If you think of the price action as a rubber band, when we start to shoot up and we get really, really extended, that rubber band is going to get stretched out. Okay? So getting super stretched out, and we know when these stocks get really extended, either to the upside or the downside, inevitably they're going to bounce back. And the point where they bounce, all the way to the equilibrium point, and then the rubber band is just loose in your hand. That will be, that's where the VWAP is. Okay, that's the VWAP, and we don't always make a full return to the VWAP. Sometimes we, we just sort of spring down a little bit and then we spring back up, and we make, seesawing waves, and we continue up. And we don't make I suppose what I'm trying to say is we don't make a full retracement to the kind of equilibrium point, to the VWAP. But that's essentially what the VWAP is, and I do find it helpful, especially if I'm looking at a trending chart. I've said before what the VWAP actually is. It's an intraday trending indicator, okay? And that's what I use it for. I look at the VWAP, and it's a good indicator of the direction that a stock is taking. Why is that? Well, quite frankly, if the price action, the candles are all forming, the starting and completing above the VWAP, that means that we're in an upwards direction. It's in a bullish mentality. It's in a bullish trend, an upwards trend. However, likewise, the reverse is also true. If the candles and the price action is all taking place underneath the VWAP, it means we're in a downwards trend, and we're in a bit of bearish momentum. And if we're getting candles that are forming below and completing above, and then starting above and falling below, it's ranging. It's a trend. It's a sideways. It's a rangy period of a stock. Those are not great stocks to try and trade unless we've got a confirmed range that it's respecting very well. But the VWAP is a very good indicator of intraday trend. Okay, and essentially those are really the only technical indicators that I like to use. The 9 exponential moving average, the 20 exponential moving average, the 200 exponential moving average, and the volume weighted average price. And of course, we don't want to forget the candlestick patterns themselves. The candlestick patterns are really what we're paying the most attention to. That's where we're going to get the flags and the breakout signals, and it's the candlestick patterns that we're looking for in the charts. We're going to be able to identify all of the areas of support and resistance and potential breakout areas that we do on an intraday basis. So when we're talking about the charts, what kind of time frames should we use? Well, the time frames I use, I've on my trading desktop, I have four charts that I'm always looking at. I have the 1 minute, the 5 minute, I have the 60 minute, and I also have the daily. Now, I'm not trading off the 60 minute or the daily, but I am trading the 1 and 5. I'm trading mostly the 1 minute, and I underpin that with the 5. I've only really started using the 60 minutes over the last few months, but what's most important is the 1 minute, 5 minute, and daily. I know a lot of traders think that the 1 minute chart is a little bit too choppy, so they might just look at the 5 minute and the daily. Personally, I use the 1 minute quite a lot, especially at the opening bell. A lot of these candles that we're looking at in the first 5 minutes, a 5 minute candle at the open, it could be a 10% move, it could be a 15% move. So when there's that much volatility, I want to be looking at a shorter time frame. A lot of my first trades that I get into in the first couple of minutes at the open, I may be able to scale out of it half the way. I was last week. I was in for a 10-cent move, and the 5 minutes it's gone up 10%. I need to be able to see that price action more clearly. I can't see it on the detail as clearly on a 5 minute as I can forming on the 1 minute. So I like to trade the 1 minute. It's underpinned by the 5 minute, but the 1 minute for me is incredibly open, especially when at periods of the day when it's we're getting the most volatility. Later in the day when we have breaking news, I might not trade the 1 minute and look at the 5 minute and get away with the 5 minute. So it really depends a little bit on your strategy and the time frame that you feel most comfortable trading. That's essentially what I'm saying. Now, in terms of the daily, I certainly look at the daily for areas of resistance, but when we have a good catalyst, the 5 minute chart for me is really where I'm going to look for my patterns, and that's where I'm going to base almost all of my trades and setups. So it's the 5 minute and the 1 minute, and less so on the daily. Okay, you can do it, but for me it's less so. So there are some traders that believe that you have to have a strong daily chart in order to trade a stock, and I used to feel that way. I used to feel that way. And I used to do a lot of scanning in the evenings, looking for good daily charts. But what I've found, and I've said this before, is that we would see a really great daily chart, like a stock that I was trading a few days ago actually, and we get a breakout, but nobody's watching it. It's a great daily chart. And nobody's watching it because there's no catalyst, so the breakout ends up being very poor. And on the flip side, you might have a stock that's got horrible daily chart. It's been selling off for the last few days, and we're looking to take a long position, or it's really choppy. It's not had a lot of volume. Really horrible daily chart, but then it has a huge catalyst, and that overrides the poor daily chart. So in a perfect world, the perfect setup, got to say, the perfect setup is going to have a strong intraday chart and a strong daily chart. But I'm willing to take trades on stocks that have a really good intraday catalyst, like earnings, news, etc., but have a weaker daily chart to take advantage of the momentum intraday. I mean, when I say a weak daily chart, what would make a weak daily chart? For me, that would be a chart that has either a lot of nearby resistance, or is blocked by moving averages. So it could be a stock that has very little volume. Let's say its average daily volume might only be 5 or 10,000 shares. That's going to be a little hard to base any of the candlestick patterns on. Okay, in the past days, looking at it, whether you look at a longer time frame, weeks or months, with that level of volume, you're going to find difficult reading the charts on a technical level to identify any patterns. It's going to be hard to see any real areas of resistance or support. volume is our best friend on the intraday. So, uh, and again, an amazing daily chart with no intraday volume is also not worth trading. This is where you get into playing games with algorithms and the high frequency traders. And you know, if you've ever tried to play chess with a computer, ultimately, unless you're Kasparov or one of the chess grandmasters, the computers always win. You know, so it's a game not even worth trying to trade. It's not worth playing because you're just not going to win. Your chances of winning are infinitesimally small. And that's why instead we focus on the high volume stocks. And here's an example. Okay, we was talking about what makes a week daily chart, and here's an example of a bad chart. Okay, this is a bad daily chart. This is Lululemon, and we've got a big gap up. If you see, got a huge gap up here. This is where we're starting the day, but there were lots of areas of, you know, clean windows. Okay, so when we opened, we had this this blue line, which is below this orange, this orange candle, and that's coloured orange with one of the indicator packages that we were running at the time. So the low of that candle, that orange candle, looks like it's 4408. It looks like. So the biggest window from the low of that candle to the high of that candle, and the high of that candle was 45.75. It looks like, okay, about $1.75. That was the biggest window that we had. Okay, and right at the open, we broke up through the low 4408 and surged up almost to the high, and we pulled in. And then when you look at that high of 45.75, well, there's the next level of resistance. Okay, there's the next level of resistance, and then we've got another one. It's very close, and after that there's another one, and another one, and another one, and another one, and another one. You can see that we also have the moving average coming down here as well, down, and that's also can act as resistance and potentially block us from getting much further above that line as well. So you have a couple of issues here. One, this stock has a moving average. Two, it has one window of profit, a big one, but then three beyond that first window, there's just a ton of resistance. So when I say, look at Lulu, this is gapping up, is there a good trigger on this chart? And you could say, well, it looks like there's a trigger at 4408, which is around here. 4408, 4410. That opens us up to 45.75, which is right here. Okay, then that's it. So this isn't horrible for like a trade right out of the gates, but beyond that, it's pretty weak. And what we end up seeing was we squeezed up to that point. You see it squeezed up. We got a move up to that first level of resistance, and and then it came in. It started selling off. So even though we had a pretty good gap and we had a lot of volume, you know, it was okay for a trade, for one trade, but this wasn't a stock that had a daily chart set up to do like a really massive move. So there was too much resistance blocking the way. So what makes a strong daily chart, in contrast, if you will? First thing I look for are these windows, and I mark them out with trend lines. So I also look for areas of ascending and descending resistance lines. That's a good question. Are resistance lines more important to watch for than the moving averages? I suppose that's a question that I've been asked in the past. Areas of support and resistance, are they more important to watch for than the moving averages? I would say moving averages are going to be more closely watched by a lot of retail traders than trend lines. So yes and no is the answer, but we'll talk about that in a couple of minutes. But basically, trend lines are, to a certain extent, they're a little bit arbitrary because we all might draw them a little bit differently. So it depends on what you're taking as your start point and finish point and how that continues. If we draw them a little bit different, it's hard to pinpoint the exact penny where the trend line resistance could come in, because it might be a trend line that you draw could be different from the trend line that I draw, and vice versa, or someone else's chart. But if we have a very clean, well-respected trend line, then it's something to definitely consider for resistance. Okay, but we'll look at that again. We'll look at that again in just a second. So windows are very important. I look for windows on a chart. A window is a large area with either no support or no resistance. So if you're trying to draw a horizontal or resistance or support line, there isn't any. That's a window. Okay. Now, a large window can be formed by either a gap or a large candlestick, but it has to be one or the other. Now, a really good window has the average true range of the stock encompassed in that window, and that's the best setups. The best setups have several big windows all lined up, so one after the other. Now, average true range, I want to talk about that. I just made mention there of the average true range. So the average true range is typically, it's just the average range a stock will typically trade in a day. So some stocks might trade a range of 15, 20 cents in a day. Bank of America, for example, its average range is like 30 cents. Whereas other stocks that are going to have a very high ATR, or average true range, I like stocks that have an average true range of at least 50 cents. Okay, it's kind of a signal of volatility. The reason that is that the more they move, the easier it'll be for me to capture a little bit of that move in the form of a profit. A stock that only moves 10 cents, I mean, I'm going to have to capture almost the entire move in the whole day in order to make my profit target. Whereas a stock that has an average true range of $5, is going to be much easier for us to find a small area on the chart to pull a piece of that profit, and we get out a little bit of that $5. Even if it's only 50 cents or 60 cents, there's much more within that range that we can capture. There's a lot more opportunities with a stock that has a higher average true range. Every time we get a flag break, there's a potential that the flag will break and squeeze up 40, 50, 60 cents. Whereas Bank of America, it'll squeeze up 5 cents or 6 cents. Okay, so a higher ATR is better when we have windows that encompass the full ATR. For me, that means it's a very big window. Now, at the top and bottom of each window is a trigger. Okay? So a trigger for me is just a price where we break that price. It's the price we get into a window, okay? So what's the difference between a trigger and a resistance point? Well basically the same thing. The only difference is that a trigger for me is going to be a potential area of resistance because we're at the bottom of a window. But there's the potential, if we break over that little area of resistance, that we open up all the way up to, $2 before we run into any more resistance. So I would call that penny, that line, a trigger. And if at that line we had another form of resistance about 5 cents away, then it's really not a very good trigger. It's just a line of resistance. So when we look at triggers, we want them to be extremely obvious. The more obvious they are, the more retail traders are going to be watching it and buying at that same point. So perhaps covering their shares with the same point, so we don't want to overcomplicate it. Okay, so I'll show you some pictures, some charts, so you can visualize this a little bit better. If you're more of a visual learner, this will be more helpful. But what we want to look for are the windows, and remember that the bottom of the window is a trigger. The top of the window is a trigger if another window is stacked right above it. Triggers versus resistance. I kind of just went over this actually. The good triggers are going to have an average true range encompassed in the window. That makes the trigger really powerful. So if the next area of resistance is only 10 cents away, there's not much power behind that. You can't really mark that as a line in the sand. It's really going to be more of a form of resistance than a real trigger. So if we look at this chart on WB, Weibo Corps, it's a strong daily chart here on Weibo. On this, the stock above to 24.48. Stock above 24.48. There's absolutely no resistance whatsoever. Okay, but let's look at this, because this chart actually had several pockets, several windows, and that's why it had such a massive day right here. If you look at this last candlestick here, this is what we're talking about. This is when it had a really big day, because it had several windows, but it went from $21 up to $25.50, from here all the way up to here. Okay, so let's look at this chart here with more trend lines. So Weibo, the first trigger on is on this one. which is this bottom line here. Okay, it's at 22.12. It was that orange candle, which is right here. This little orange candle right there. 22.12. Now, above 22.12, we had a little bit of a blip here, which we can see a little bit more on that previous candle, which is the top of that doji. So that was made 22.12 a potential area of resistance. But if we could break over that and get over the doji, then we have room up to 23.32, which is kind of this next area here. Okay, so room all the way up to 22.32, and if we could break 23.32, we break 23.32. The next logical level is then right up to the highs. So okay, now I would say this right here, this hive candle could potentially be a resistance level here as well, kind of around the 24.20 level. That could be a potential resistance as well, because right here we've got a high so close to it. But if we can get above that, and because this is a recent IPO, this is a line in the sand that it's really going to be catching a lot of people's attention. So this is what I do every day when I pull a stock off the watch list, and I look at the Gapper scanner. I start making out trend lines of nearby areas of resistance and looking for windows, maybe throwing in a trend line every now and again, depending on what I could see. So throw a trend line right here, from here down to here, maybe, but mostly I've been looking at these critical areas of resistance. Now, say trend lines. How do you draw a trend line? What is it? Well, with a trend line, when you're drawing trend lines, the important thing to note is that the more times a trend line has been tapped, the more validity it gains. So it's been confirmed. I'm looking for confirmation. So a trend line that's only been tapped twice, once when you first drew it, and then the second time where you connected it, might not be a very strong trend line because it's only been tapped twice. It's possible that no one is watching it. Okay. Whereas a trend line that taps multiple times is going to be a little bit more reliable. It's going to be a little bit more respected. The price action is likely to, is likely to be more relevant. Let's look at this and look at this gap up. Okay. And here on this next chart, here we have an example of a window here with no resistance. So this is a window right here, and we have this gap. As soon as the stock starts to break into the window, we know we have a potential for what's called a gap fill. The stock could sell off all the way down. So a little gap up, and then if it breaks into the window, it could then sell off all the way down to this previous level here, down to that level. So we know that 1986 is potential area of support that we've got in that window. The catch is that the moving average is also support. So if we're looking to short this, we would say this short, this gap fill, we're getting to the gap, and this is a very significant trigger. This 2212 area. We do have the moving average right there that could be an area of support. Okay, so that's where the moving averages comes in. It comes in. It can come in handy. So now here's one that's a little bit better. This is a gap. This is a gap with a window right here. Okay, and the gap down. All we see is how big that window actually is. It's huge. Okay, it's from 614 all the way to the high over here. Okay, so that's over $7. So we're looking at over a dollar window there. So once we get into that, we have no resistance, and we're above our moving averages, so that makes it even cleaner. So the moving averages are down here. We've got over the 614, which is above the moving averages. We've got no resistance all the way up to these levels here, making it a clean window, and that's where we get that really nice move we get at the break, and the next day we get a little bit of follow through. You notice the volume was higher on the first break. The volume spike here than it was on the second one. That's typical. That's typical behavior. Now, this one here is an example of a stock that we traded before, and it was gapping up. So it was gapping up here. Open at 727, and where was the first big trigger? It was 845. So, and then 1065. So that's a big window. It's a really nice big window. Right here at 845. And then up to 1065. Because we've got that candle here, which is creating the window. One big candle giving us that window. Okay. We have moving average here. Down below it. And then comes the 200 moving average here. That could be a little bit of a problem, right? But the first issue is from the open up to 845. That's our first area of resistance. Okay. And I guess when the stock opened, it popped up to 845 and then pulled in. The second move up was to 849. You see it here on these charts. Okay, so the second move, it moved up to 849. So this little area on the chart was probably being watched by a lot of traders. When I draw a trend line, do I draw it on the daily time frame? And the answer to that is yes, sometimes I do. The reason I say that is sometimes if you draw a trend line and the stock continues to move up with that trend, then that trend line can be relevant no more than just for a short time frame. It can be relevant intraday as well. So it can be relevant to draw uh, trend lines across multiple days. Okay, and if you're drawing a trend line, you can draw multiple trend lines. You can draw a top and bottom trend line to create a channel if you want, and then it looks like you're trading within that channel. And if you're getting a stock that respects a channel, a trend channel, you can take profit by buying the highs and selling, buying the lows and selling the highs of a channel like that as well. So this is our example on a stock gapping up, and just want to just give me a second, see if I can. Okay, so I just want to talk about this stock here. A couple more gap examples. Okay, this was a pretty big pocket. There's a pretty big pocket in the chart here. You see when this was gapping down, we saw that there was, as it turned around, we saw there was a big window. We're moving down, it gaps down, then we've got a big window here, a big pocket here, for us to look for potential profits. Okay, there's a big window right in the middle of the chart. So we had a big gap down, and that created a big window. It can either be big gaps or very big candlesticks. So the gap here is another little gap there. So big candlesticks like the green ones in the middle of the chart here, and the gaps can often be where we create the windows. Okay, so they can create the windows. And we've got a little bit of a window to the downside here as well. Okay. Now, a gap fill. So I made mention of a gap fill, and that's simply when a gap is filled by price action. That's pretty self-explanatory. So a gap fill is something that we aim for. We aim for stocks that make small gaps up, and we look for them to gap down. Or when a stock is approaching the trigger trigger line of a gap, trigger line of a gap window, we can look for potential gap fill all the way up to the other end of the gap. Okay, so in certain cases we could see a really big move, a big gap fill. A big fill seems to be more common on the selling side, with stocks are just grinding down all day long and sell off all day long, versus stocks that are moving up. But a gap fill is kind of like it's kind of like the VWAP, where that may be our ultimate trigger, our ultimate target, but typically we don't fill the entire gap. But you know, if we get halfway there and it's a 10-point gap, then we still have $5 of profit. You know, there's a lot of potential that's still there. So if you want to scan for daily charts, you can use free scanners. You can use stock charts or Finviz. Trade ideas can also be used for scanning daily charts. Like I said, I like to use Benzinga, and you can do it on the daily as well. But like I said, I don't do a lot of it. But if you want, when I see a good daily chart, I I look for a price point that I think it could be worthwhile entering at, and pretty much forget about it, okay, until it hits that price. Um, so I'm not a big fan of scanning for daily charts. I'm more of an um, intraday trader. So that's what I'm looking for. Okay. So I don't worry about daily chart watch lists. And as somebody starting off as a beginner day trader, um, you have a lot of work adding, and you're just adding more work. Don't do it, is what I'm saying. It's more work than you need to. There's a lot to learn, and then adding the daily charts to that as well. It's really not necessary. It really isn't necessary. So in terms of doing daily homework, scanning for daily charts with really great triggers, and you can do if you want the practice, but I don't think it needs to be part of your daily routine. Right? It's not part of my daily routine, and I'm doing fine trading. So I don't think you need to focus on that too much. Um, Instead, spend your time relaxing, taking a little break, and then get up a little earlier in the morning or whatever the time frame is before the market opens, so you can actually do research into the pre-market. I think one of the worst things you can do is get to your get to your computer at 9:25, and when the bell rings at 9:30, because there's no way you're going to be able to do your research in that short space of time. So you're going to be kind of groggy. You're going to be, not ready. You've not got the relevant information to hand. You're not going to be able to focus. So take a little bit of time before the market opens to do a bit of research on the pre-market. If you're not able to focus properly, you're going to make bad trades at the open, and you're going to lose money. And that's what we're trying to avoid. That's what we're really trying to avoid. And look at my trading. From the open, I do like to trade. If you're with a broker that facilitates it, not all brokers facilitate it, but if you're with a broker that does, you might spot something pre-market that's got relatively good volume, and be able to take a trade pre-market. But I like to trade pre-market. I still make more money between 9:30 and 10 a.m. market time. That's when I make the most money. So you want to make sure that you're ready, and you have enough time to take full advantage of the opening range. The easiest time to make money in the markets is that opening 30, 60 minutes. Now, daily chart patterns. If you want to look at daily chart patterns, this is what I would suggest you do a bit of research on. You can, if you go into Google and stick these flat top patterns, chart patterns, flat bottom chart patterns, bull flags, bear flag, you stick that into Google Images, you will get hundreds, if not thousands, of images that show you exactly that. So, have a look at some of these chart patterns, and so that you can start to recognize them. Okay, you get to see what they look like on in a charting context. You get to see what it looks like if you have a particular platform you like to trade in. Tap that into your Google search as well. So if you're using Dash Trader like I am, say flat top chart pattern Dash Trader, and it will pull up a whole bunch of images on Google Images for that. And you can get to recognize on whatever it is your favorite charting software, or whatever it is your favorite platform, trading platform that you're using. You get to recognize the patterns. Okay, so you take a look at it, and we're going to go over these in a little bit of. We're going to go over these in a little bit more detail in a later lesson. But you can look at these on the intraday charts. It's the same patterns. It doesn't matter if it's a 5 minute or 1 minute. The intraday charts are the same that we see on the daily charts. The only difference is that, you know, for me, the more important on the intraday time frame. And the reason for that is there's more volume. So if you look at a flat top pattern on a daily chart, you know how well respected it is going to be when it breaks out. If no one's watching the stock, no one's going to care. It might break by 10 cents and then pull right back. So I don't do a lot of scanning for the daily charts or daily chart patterns, but you know, you can recognize them. The patterns are they're the same patterns that we look for on intraday charts. I just prefer to trade them on intraday charts. Okay, so setting up. If you're setting up your chart, we do this to give us a better understanding of the context of current price action. So this allows us to make well-educated decisions and reduce our risk as traders. And again, this is just another level of risk management. Everything that I'm doing when I'm trading is finding ways to mitigate risk. I've got my risk management principles, the 2-to-1 profit loss ratios that we spoke about in lesson 2. We're aiming for percentage of success that's at least 50% in terms of accuracy, and then I'm making sure I'm only trading the right stocks, which was lesson 3. I'm only looking for the right stocks based on the preset criteria that we discussed in the last lesson, and we're looking for relatively high volume stocks with a good catalyst. And then I want to make sure that my charts are set up properly and I understand the value of these triggers, these entry and exit triggers, and I understand what makes a chart a strong or makes a chart a weak chart. Okay, so these are all levels of a varying degree of risk management. So although lesson 2 was about risk management, so far all that I've taught you so far is a varying degree of risk management, and it's what helps us trade safely and hopefully trade with positive profit loss ratios and a high level of success. Okay, so anyone that has any questions on what we discussed today, if there's any areas that you want a little bit more detail, drop me an email with the questions. These are the tools that I use for charting and documenting charting. I use TraderView, Benzinga for my scanners, TraderView, not to be confused with TradingView, for documenting my trades. Take a look at them. Take a look at them. Okay, and that's it for today. We'll come back tomorrow in the next lesson, and we'll talk about intraday chart patterns. We've covered a little bit off of that today, but we're going more in depth with intraday chart patterns in the next lesson.